funding growth is a big blind spot for small and mid-sized companies. It costs money to grow. That's okay. But planning for that cost and appreciating what the cost is going to be is crucial. Just as an industrial company, a manufacturer or distributor would not think of doubling in volume without first understanding, well, how many more shifts do I have? Do I have enough capacity in my machines? Just as a business services company wouldn't say, I can process 1,000 more orders. Do I have the manpower? Do I have the computing power? You need to, in a good, robust growth plan, you need to plan for how you're going to fund the level of growth you're thinking about. Aggressive growth targets, even when they're achieved, can severely deteriorate your financial performance when companies don't think about this. I looked at a company and I did it across 3 different business types: manufacturing, distribution, and business services. I took a company at a baseline revenue of $20 million in year 0 and grew it at 20% a year. So it gets to just under $50 million in year 5. And then I started looking at some of the things that I've seen in my advisory career about what can happen to profitability and what can happen to working capital when growth turns from good to bad. And this was not any one client that I've had, but very much drawing on my experience advising clients. And what I started to see was you can, in the EBITDA variance, you can see manufacturing especially, you can see a pretty substantial drop in profitability by dollar value in manufacturing. And for business services and distribution, it wouldn't be uncommon to see a decline in profitability by EBITDA margin, even though your dollar margin might be going up. Now, this is important. Too many times, companies that are in a growth mindset, they get away from that measurability aspect. They get away from how am I going to grade whether or not this growth is good. If EBITDA is going up every year, that doesn't mean you're a healthier company if your EBITDA margin is failing. It's about having objective benchmarks and grading against them. Working capital, to me, is an even starker example. Working capital for a manufacturing company growing at 20% a year over 5 years, it would not be uncommon for that working capital impact to be $9.2 million. You're going to have to fund that. That's net working capital. Where's that $9.2 million going to come from? Is it going to come from owner's equity? Are the owners willing to reduce shareholder distributions? Is it going to come from debt? Have you looked at your borrowing base calculation? Do you need a term loan? Do you need mezzanine financing? Are you going to need private equity backing? Understanding where that $9.2 million is going to come from is absolutely crucial to the sustainability and the achievability of your plan. Get away from manufacturing for a minute. For distribution, same growth profile, you're talking about $7.5 million. Again, same question though, but in distribution, you're talking about a lower profitability business. Business services is a little bit easier. Look, the hit looks to be about $5.3 million, and that's because business services companies generally don't have any inventory. So they have the ability to grow faster. But still, growth comes with costs. Growth comes with real, measurable cash costs. And understanding that, understanding the financial constraints that a business faces when it seeks to grow is crucial to targeting the right level of growth, measuring it, and hitting it. Because if you exceed the level of sustainable growth, you're growing your way into a problem.